Welcome to our deep dive into the world of exchange-traded funds, specifically focusing on VOO and VGT. Exchange-traded funds, or ETFs, play a crucial role in diversifying investment portfolios, offering a blend of stocks, commodities, or bonds in a single package, which makes them a favored choice among investors. Our spotlight today falls on two particularly popular ETFs, VOO and VGT. The Vanguard S&P 500 ETF, known by its ticker VOO, is a fund that aims to track the performance of the S&P 500 index. On the other hand, the Vanguard Information Technology ETF, ticker VGT, targets the information technology sector of the U.S. equity market. These funds are managed by Vanguard, a name synonymous with low-cost, high-quality funds. The company's commitment to investors' interests has made it a trusted choice in the investing world. Stay tuned as we delve deeper into the specifics of these two popular ETFs. If you are enjoying this content, and you do not want to miss future videos filled with even more tips, tricks, and inspiration, hit that subscribe button now to stay tuned with us and remember to comment and share. First, we dive into the Vanguard S&P 500 ETF, better known as VOO. This exchange-traded fund, or ETF, is designed with a focus on large-cap U.S. equities. Essentially, it aims to track the performance of the S&P 500 index, a widely recognized benchmark of the U.S. equity market that includes 500 of the largest U.S.-based companies. When you invest in VOO, you're essentially buying a small piece of these companies spread out across multiple sectors. One of the key strengths of VOO is its low expense ratio. An expense ratio is essentially the cost to invest in the fund, and lower is generally better. VOO's expense ratio is just 0.03%, which is incredibly low compared to the average. This means that for every $1,000 you invest, you're only paying 30 cents in fees per year. Also, VOO has a strong performance history. Since its inception in 2010, it has consistently matched or slightly outperformed the S&P 500 index. This means that if the S&P 500 index goes up, typically so does VOO. And if the S&P 500 goes down, VOO usually follows. However, it's important to note that investing in VOO, like any investment, does come with risks. For one, because it's tied to the S&P 500, it's susceptible to market volatility. If the market takes a downturn, your investment could decrease in value. Additionally, while VOO is diversified across many companies, it's still heavily weighted towards the largest companies in the index. This means that if these companies perform poorly, it could significantly impact the performance of VOO. Despite these potential drawbacks, many investors appreciate VOO for its simplicity, low costs, and consistent performance. It offers a straightforward way to gain exposure to the U.S. stock market, making it a popular choice for both novice and experienced investors. Now that we have a solid understanding of VOO, let's shift our focus to VGT. Next, we explore the Vanguard Information Technology ETF, or VGT. Let's dive right into the specifics of VGT. This ETF is laser-focused on information technology equities. It's designed to track the performance of the MSCI US Investable Market Information Technology Index, an index made up of stocks of large, mid, and small-sized US companies within the IT sector. Now let's talk about cost. VGT comes with an annual expense ratio of 0.1%. In simpler terms, for every $10,000 you invest, you're only paying $10 in fees annually. That's a pretty affordable deal, especially when considering the potential returns from the booming tech industry. Speaking of returns, let's take a look at VGT's performance history. Over the past decade, VGT has consistently outperformed the broader market, thanks to the impressive growth of tech giants that dominate its portfolio. While past performance is never a guarantee of future results, it's always a good indicator of a fund's potential. Now, onto the strengths of VGT. First, it offers concentrated exposure to the tech sector, which has been a powerhouse of growth over the past decade. Second, it has a low expense ratio, making it a cost-effective choice for investors. And third, it's managed by Vanguard, a highly regarded name in the investment world, known for its investor-friendly practices and robust fund management. But there's no such thing as a perfect investment, and VGT is no exception. Its potential drawbacks lie in its concentrated sector exposure. While this can lead to high returns when tech stocks are booming, it can also mean higher volatility and potential losses when the sector is underperforming. With a clear understanding of both VOO and VGT, we can now compare and contrast these two ETFs. In this segment, we place VOO and VGT side by side for a comparative analysis. Let's begin with the investment focus. VOO, or the Vanguard S&P 500 ETF, is designed to track the performance of the S&P 500 index. It's a broad market exposure tool, ideal for those looking for diversified, low-cost access to the largest U.S. companies. On the other hand, VGT, the Vanguard Information Technology ETF, targets the tech sector of the U.S. market, investing in stocks of companies operating in areas like software, hardware, and IT services. It's a sector-specific tool, more suitable for those willing to take on sector-specific risks for potentially higher returns. Moving on to expense ratios. These are the fees that you pay to own the funds. VOO has a low expense ratio of just 5 basis points, while VGT's expense ratio stands a bit higher at 10 basis points. In terms of performance history, both ETFs have a strong track record. VOO, being tied to the S&P 500, historically provides steady and reliable returns. VGT, however, given its focus on the tech sector, has seen more pronounced peaks and valleys, reflecting the volatility of the tech market. Each ETF carries its own set of potential benefits and risks. VOO's broad market exposure and low cost make it a stable investment, while VGT's sector-specific focus could offer higher returns but comes with increased risk due to market volatility. As we've seen, both VOO and VGT have their unique features and potential advantages. In conclusion, both VOO and VGT ETFs offer unique investment opportunities. We've delved into their structures, examined their benefits, and contrasted their performance. Remember, the choice between them hinges on your personal investment goals and risk tolerance. Like any investment, these ETFs require careful consideration and research. Thank you for joining us on this exploration of VOO and VGT. If you found this analysis helpful, please subscribe, like, and share our video to help us reach more investors like you.